Welcome, everyone. So glad you can join us for this mid-year economic update. As you know, the JFL office joined forces with OneDigital at the beginning of 2023. We have a lot of new resources in our back pockets now, and hopefully you've been able to take advantage of them. The day-to-day management of our clients' financial plans remains in the hands of the JFL-OneDigital team that includes three CFPs, Jerry Lynch, Jeanne Kane, and Matt Rembish. Today, we're going to talk about what's happened to date in 2023, as well as touch on recent headlines about artificial intelligence and a possible recession, plus key tips you can focus on for the remainder of the year. Jeanne Kane is going to take us through the recap and the outlook. Jeanne, take it away.
Thanks, Gretchen. So the first half of the year has proven to be remarkably resilient. The economy remains strong thanks to a robust job market and consumer spending. The financial markets have done surprisingly well so far this year, considering there were multiple bank failures, debt ceiling uncertainty, rising interest rates, all happened earlier this year. So the S&P 500 was in fact up almost 17% through the end of the second quarter, and the NASDAQ was up over 32%. The Fed is anticipating real GDP growth, lower unemployment, and reduced inflation, and lower risk for a potential recession. On the flip side, there are still risks out there. The Fed raised interest rates 4 times this year for a high rate of about 5.5%. Is this too much? Too fast? We dodged a bullet earlier this year when Congress raised the debt ceiling at the very last minute. Now, the Fitch bond rating agency recently lowered its rating of the U.S. from the top rating due to repeated debt limit political standoffs. So the downgrade is really more of a statement about politics in the U.S. than about the U.S. economy. And the debt ceiling could end up being a bigger issue that needs to be dealt with in the future. And now, because of what happened earlier this year with Silicon Valley Bank, Signature Bank, and First Republic Bank, regulators are tightening standards, which may make it harder to get loans. So inflation. So if we look at consumer prices through the end of June, they rose about 3%. This is down from 4% in May of this year, and just 1/3 of last year's peak inflation rate of 9%. Inflation is at its lowest level since March of 2021. Now, the Fed raised interest rates in late July, bringing the federal funds rate again to that range between 5.25% and 5.5%, fourth increase so far this year, and the 11th since March of 2022. And the Fed signaled they may not be done yet. Their target inflation rate is 2%, so there's still a little ways to go. So let's shift gears a little bit to talk about the investor outlook. So those higher interest rates, they are a boon for income-producing investments. We're seeing high-yield money market funds over 4.5%, CDs over 5%. The last time we saw these rates at these levels was before 2008. And in general, a bad year in the markets is followed by a good year. In fact, there have been only 3 times since 1936 that the S&P 500 was down consecutive years. 2022 was a down year. 2023 is up year to date. So odds are we'll likely have a positive finish to the year. Now, lending standards may get tightened as a direct result of those bank failures earlier this year. This could impact the ability for businesses and consumers alike to get loans. Now, ChatGPT pushed artificial intelligence, or AI, into the mainstream spotlight. Questions about safety, accuracy, and impact of the workforce are all related to AI. Now, AI isn't necessarily new. It's already here, and it didn't start with ChatGPT. It's used in so many areas of your life, from a smartphone to medical settings. And you're likely already invested in AI. And that's because companies like Microsoft and Google or Alphabet, they've all been mainstays in this area. And at AI's core, big data. This is used to build complex algorithms that can take new information to improve performance and accuracy. And in the financial markets, we see it strengthening the accuracy of security pricing, making markets more efficient. Now, the big R word, the recession. A recession is defined as 2 quarters of GDP declines between a market economy's peak and its trough. And while many economists were predicting a recession for 2023, time may be running out for it to materialize this year. And keep in mind, each recession is a little different, and not all will look like 2008. So what are some things that you can do as an investor? Well, first of all, review all of your income-producing investments. Those higher interest rates mean high rates for high-yield money market funds and CDs. Stress test your money. The FDIC insurance only covers your cash up to $250,000 per account type per bank. And in light of recent events, you really should make sure that you're under threshold, that $250,000 threshold at your various banks. And is your emergency fund funded? Maintain liquidity for all near-term cash needs. You should have 3 to 6 months of expenses covered in the bank and in your emergency fund. And then finally, review your financial plan. You want to think long-term to avoid short-sighted missteps. Thank you all for joining us today. I was really excited to walk through the second quarter economic update and investor outlook with you. If you have any questions at all about the presentation or want to speak about your personal financial situation, please give our office a call. We'd love to talk to you. Thank you.